Good morning and welcome to Earnings Echo. While my bosses were asleep, we put together the most important information about Alphabet.
Yeah, and if you were watching that stock ticker after hours, you probably needed a stiff drink. It was a complete roller coaster.
Seriously. I looked away for maybe 10 minutes. The stock had created 14%. Then I looked back and it was green.
Before we get to that whiplash, let's just ground this in the actual performance. Was the quarter itself actually good?
It was better than good. It was a clean sweep. Revenue had $113.8 billion. That's up 18%. And earnings per share landed at $2.82, which is up 31%. Wall Street was expecting way less on both.
Okay, so operationally, they're printing money. Usually a beat like that sends the stock soaring. So why the initial free fall?
Well, it all comes down to one terrifying number about their future spending. But to understand why the market eventually forgave them and the stock bounced back, you have to look at where that revenue came from.
Right, the drivers. And I'm guessing this isn't just about selling more ads on Google Search, is it? Not entirely, no. The star of the show here is, without a doubt, Google Cloud. It's finally become the monster everyone was waiting for. Revenue there hit $17.7 billion just for the quarter.
Which, it sounds like a lot, but give me some context for that.
That's 48% growth year over year, almost 50% growth.
Yeah.
At that scale, that's just unheard of. Their annual run rate, so if you annualize this quarter's performance, is now over $70 billion.
Wow, that is massive. That's practically a Fortune 500 company just sitting inside their cloud division. So the AI demand isn't just hype anymore. Companies are actually paying those invoices.
Yeah, exactly. And, the legacy cash cows are holding the line too. Search grew 17%, YouTube ads were up 9%. If you combine YouTube ads with their subscriptions, that platform alone is generating over $60 billion a year.
So you've got massive cloud acceleration and steady ad growth. How did the margins look?
Healthy, very healthy, 31.6%. And they would have been even higher, but they took a $2.1 billion hit on employee compensation related to Waymo.
Ah, the self-driving cars. We'll circle back to that, but we have to address the elephant in the room. You mentioned a terrifying number earlier that caused that 14% drop. Lay it on me.
It's the capital expenditures,
Yeah.
CapEx, what they spend on infrastructure like servers and data centers. Management issued guidance for 2026. They plan to spend between $175 billion and $185 billion.
Whoa, wait, did you say 185 billion?
Billion in 1 year.
That is staggering. The market was expecting what, maybe $120 billion? They're nearly doubling the infrastructure bill.
And that's why the algorithm traders just panicked. On the surface, it looks like they're burning cash. But CEO Sundar Pichai was extremely bullish on the call. He argues this is the necessary foundation for AI. He even drops some stats to prove the demand is real. The Gemini app now has 750 million monthly active users.
It's a lot of eyeballs.
And on the developer side, their API is processing 10 billion tokens per minute. The argument is the demand is crushing their current capacity, so they have to build.
So that explains the recovery. Investors did the math. Okay, you're spending $185 billion, but your cloud revenue is growing almost 50%. It's a high-stakes poker game, but the cards look good right now.
Precisely. And just briefly on that Waymo charge we mentioned, it's actually a sign of success, believe it or not.
Yeah.
Waymo is doing 400,000 paid rides a week now. They just raised $16 billion in an outside investment round, which jacked up the valuation.
So the higher valuation triggered the compensation charge.
Exactly. So expensive, but working.
And that seems to be the story of the quarter.
That's the echo for this quarter. The costs are terrifyingly high, yes, but the growth, specifically the cloud acceleration, proves the AI bet is paying off financially today.
Not just in some hypothetical future.
It's paying off right now.
It's a brave new world of spending, apparently. And finally, the obligatory disclaimer. All content in Earnings Echo is AI-generated information and does not constitute investment advice. Investing involves risks. We assume no liability for your investment decisions. Do your own research before taking action. Numbers checked, portfolio prepped. Catch you again soon.